Okay, welcome back to the channel, guys. Today is a very fun day because I am going to be talking about Nvidia. Um, Great company, love their products. Their graphics cards are phenomenal, and they've been utilized for many different things. For example, they've been used for uh, machine learning, and they've been used for um, cryptocurrency processing. So lots and lots of use cases for their products. Love what they've done. Um, let's talk about the business really quick. So in the last 12 months, trailing 12 months, they've had earnings of $3.73, and that has translated to a free cash flow of $3.21. So that's really nice that earnings and free cash flow are sort of meeting up together. That sort of indicates that the company is doing a pretty decent job of converting earnings to money that's actually usable. So that's a good thing. One thing that I don't like, though, is the pricing, and they're hitting a price to earnings ratio, and because their free cash flow is so close, it's a little bit higher, the price to free cash flow. They're hitting a 48, which is very high. Remember, the average of the entire stock market over time is about 15. 48 PE, that's incredibly high. It could be justified because they have been growing really rapidly. So take that for what it's worth. They've been growing at about 30% a year, which would put them at a PEG ratio of 1.5, which is also indicating quite a bit overvalued. They do have a tiny dividend of about 16 cents per share per quarter. That works out to, 0.09% yield a year, which isn't great. Their market cap is $452 billion. One of the things that I like looking at is the return on equity and the return on invested capital. And Nvidia actually has a very interesting story to tell here. So over the last 10 years, prior to 2017, their return on equity and return on invested capital has lingered in the low teens area. And that's okay. It's not particularly great. But after 2017, they've jumped up to the 20% mark on their returns. And the question becomes why? Why would that happen? And the answer is pretty obvious. 2017 was a big year for crypto. That's really where the demand for their products took off, and they realized they could charge higher margin. They could get better margins, essentially. So that's what they've done, and they've been in the low 20s ever since. Here's my thing I want to caution you guys against. That means that Nvidia's stock price is going to be very correlated with cryptocurrency prices, right? And the demand for cryptocurrencies. If you continue seeing elevated demand for cryptocurrency mining, Nvidia is going to do great. But they're going to see a massive slowdown if there is ever a drop off in demand for cryptocurrency. So that's something to be aware of with Nvidia. You are making a play on cryptocurrency. One other thing that I do like to look at is the number of shares outstanding. I like to understand, are they repurchasing shares? Are they diluting you? What's going on there? And they've held basically constant at 2.5 billion. They've issued a lot of shares, but they've also bought those shares back, which sounds like they're just buying back the compensation that they're giving to the executive team. So they're not really diluting you. They're not really returning cash to you. It's just the way that it is. They've held pretty constant. So that's an okay, right? We'd prefer to see the share count going down because that indicates that they're returning cash to the shareholders in a very efficient way. But frankly, I don't. With a PE of 48 and a PEG ratio above 1.5, I think it makes sense for them not to be buying back shares right now. So I don't fault them for that. So let's talk about free cash flow and a discounted free cash flow model. Per my usual assumptions, I'm assuming a 15% required rate of return with a 4% with the analysts expected growth over the next couple of years. The analysts are expecting it to grow at 22.8% per year. That puts it with a 4% growth rate on a terminal value. That puts you at a valuation of $81.69 per share. You might go 4% for Nvidia as a growth rate over in its terminal value. Why? The reason why is basically it's going to grow with the economy, right? 2% inflation, 2% growth on the economy, real growth on the economy. So that's sort of the idea behind what's going on with that 4%. We're just going to expect that it grows with the economy after so many years. It's a very conservative thing to assume, right? So that gets you the $81.69 per share. That's my target price for Nvidia. And you might go, wait a second, how much is Nvidia actually trading for these days? And it's trading for $181.63 as of closing on Friday, which is quite elevated, right? It's very, very elevated, that price, compared to what I'm saying is fair. What's a fair price for Nvidia? At least a price that I'm willing to pay for Nvidia. And you know, that's more than half, right? We're going to cut it by more than half, is what I'm saying. I'm not sure we'll actually ever get there, right? The problem is that Nvidia is growing. It's grown very quickly over the last decade, and people are anticipating that to continue to happen. And I'm asking for a very greedy 15% return, right? So is it going to get down that low? Probably not. Probably a more realistic way to look at this is, let's assume the analyst growth rate, 22.8%. And let's look at what the return would be at the current price. So the current price implies a long run return on Nvidia shares of 6.85%, which isn't super great. That is market trailing type of returns, which isn't surprising given that all of the other valuation metrics we've looked at are quite elevated. So where does that leave us? Well, let's take another look at this. Let's say that we want a 9% return. What growth rate would Nvidia have to achieve to get us there? And it turns out that that's about 26%. Again, that's not terribly crazy given that they've grown about 30% a year over the last 10 years, right? So that's achievable, right? So there, in some sense, the current price is justifiable. It's not so high that I'm like, ugh, you'll never get a market matching return or anything like it at the current price. It's really what I'm seeing is the price is kind of okay-ish, right? You might bet that Wall Street analysts are being too conservative, and you could justify the investment. I think it's a little too hard to justify the investment at the current price. All right. So let's take a look at their capital allocation strategy over the last couple of years and see if that sort of jives in our head with this idea that they're going to be able to get up to like that 26% return instead of the 23% return that analysts are expecting. So they've done about $1 billion a year for the past 2 or 3 years in capital expenditure. That makes a lot of sense. They're building out new products. They're building out new factories. They're ramping up for that, especially with the semiconductor bill that just passed the Senate. I think that makes a lot of sense. They're investing back into themselves, right? In 2021, they did a minor acquisition for their market cap. They got a market cap of almost $500 billion. They spent $300 million in 2021, so not a big acquisition. They did have a fairly large acquisition in 2020, though, and that would have been the Mellanox Technologies Incorporated transaction. They probably had some other teeny tiny little nibbly acquisitions along the way, but that closed. And they paid $8.5 billion in company purchases and acquisitions. So that does seem to be a bit of a trend. They seem to be acquiring a lot of businesses at the moment. That kind of worries me a little bit. Not because it's not a bad strategy for growth for a $500 billion market cap company. It worries me that they're taking on so many acquisitions so quickly. I think that that's going to make it a little bit hard to integrate those businesses into their current major business. So we'll see. We'll see how that plays out. But they're kind of going on a shopping spree, right? It seems like they have so much cash they don't know what to do with it, and they don't want to return it to shareholders, so they're buying businesses. Not a terrible strategy, but it does concern me a little bit. And so we talked about how they're not repurchasing shares, really. They're not paying much of a meaningful dividend. We talked about acquisitions. We talked about reinvesting back into the business. The one thing that I didn't talk about when I talked about reinvesting into the business was research and development costs. How much are they doing in that? Because that could actually change things a little bit. Instead of $1 billion, They could be doing quite a bit more. That would be under operating expense. They did, look at that, $5.7 billion of research and development in the last 12 months. They did $4 billion. The year prior, they did $3 billion. The year before that. So they're doing a lot of research and development, which makes sense, right? That's where they're spending their money. So we're really talking about, $6-7 billion in research and development costs. That's not in reinvesting back into the business. So I think that makes a lot more sense. Oh, that fly. Jeez, do you see that? It just attacked me. Anyway, getting back to onto the topic, they did quite a bit of they did a lot of research and development. So a lot of reinvesting back into the business. I like to see that. That makes the most sense to me. I think that they could do a little bit more in that space instead of in the acquisition space. But that's just my opinion. The last capital allocation strategy, because there were 5, right, that they can do is pay down debt. They haven't really been paying down debt. They've actually been taking on debt over the past couple of years. I think that makes sense given the interest rate environment that we've been in. I'm not going to fault companies for taking cheap debt. So the fact that they haven't been paying down debt and they've actually been taking on debt makes a lot of sense. Their long-term debt to EBIT, which is the ratio I like to use, is just over 1. So it'd take them 1 year to pay off all of their debt if they just focused on that. So they did a pretty decent. I feel like their capital allocation strategy is decent. I don't think that it's fantastic. I think there are some things that I would tighten up, but playing armchair quarterback instead of playing armchair CEO instead of playing actual CEO is much, much different. So I'm not going to fault them for having a decent capital allocation strategy, in my opinion. So I think that 26% might be achievable. So if you're just looking for sort of market matching returns, Nvidia might actually do it for you. I'm not a super fan here. Like I said, I would prefer to see it in that $80-ish range. And I think that we could see it, but looking at the company, just looking at the numbers, knowing what I know about Nvidia, it seems okay. The thing that really, really concerns me is what happens in a crypto winter, like a true crypto winter, where prices collapse. Everybody says this is a scam. Nobody should be buying Bitcoin. Ethereum's trash, right? In that sort of scenario, Nvidia is going to suffer, and they're going to suffer a lot, which is why I'm like, ugh, I don't think that I would pay these prices. But if you're an incredible bull, I think that you've got a case, right? I think that you've got an actual case here with Nvidia. I'm just going to sit back and wait and see how it goes, because there's too much uncertainty here for me. So take that for what it's worth. That's my thoughts on Nvidia. It's hard to do a complete analysis on a company in just 20 minutes. So take that for what it's worth. And until next time, stay rational, my friends.